Hey, it's Soleil, and this is episode 261 of the Orange Pill Investor. And today I want to follow up on my earnings crush research I did from yesterday. Tesla really didn't cooperate. They're up like frickin' 20%. So I don't know if I'm going to be able to positively correlate this. And then also rip to my covered calls. I always close my covered calls before earnings on stocks that I am bullish about, and I forgot. So rip. Um, Implied volatility did drop a little peg, so it'll be interesting to see if this continues to drop tomorrow and the next day, like we've seen in the past for Tesla. But let me just first, since I only have 23 minutes before the market closes, let me see if there's any profit taking I need to do here, because I have a few of these Tesla long calls, so these should be doing well. Average cost is 75, and they are at 120. There's a penny stock trader that I used to follow back when I was a dirty shitcoiner, and he said that you always participate in the bounce. And so I'm going to take this opportunity to sell one of these bad boys. And if I can get a fill, that would be nice. But I guess I'll try to sell it for a penny less. What did I try to sell it for? Let's just do this. Let's just hit the bid. All right. Took a nice little, what is that? 30%? Yeah, more like 40% profit maybe on this. Actually, more than 50%. 50 cents. Yeah. Um, let's see what else I got. The other Tesla call should be doing pretty well, but this one's good to go until at least March. So I'm not feeling any urgency about closing this one. My RIOT 9.5 put, I can close this. Because I sold it for 36 and now I can buy it back for 4. So I don't think I really need to hold this until tomorrow. I can go ahead and get my collateral back. I think I kind of overspent anyway. I didn't really mean to use as much margin as I did. It still says low risk, but I don't really trust Robinhood's calculations. They're all over the frickin' place. I still do have these two CLSK 12.5 puts. I sold these at the money, kind of intentionally, because I was kind of hoping to get assigned. I'm so upside down on these that the covered calls I have on are actually below my cost basis. And that's something that people ask me about, and really people when they first start selling the wheel, or just critics of people who have never run the wheel, will say, "Well, what if the price crashes and then now you're at risk of losing money?" Yeah, well, no shit. Everybody's at risk of losing money in the stock market. If you buy share, even if you don't run the wheel, even if you're not an option seller, if you buy shares and the frickin' price goes down, then you know you lost money. And if you panic and sell, now it's on the books and you can claim it as a loss on your taxes. So if I bought here at 23 and yeah, I lost money if it went down to 8 or 9. But the point of this strategy is just constantly reducing cost basis. So do I care that I'm going to have to pay to roll these, or else they'll get called away? No, I don't. And in fact, since I have two 12.5 puts that are going to be assigned, if I just let these get called away, I'm still going to have 200 shares. So I'm running both sides of the wheel at the same exact time. And actually, the $12 strike might not get called away. So the 11, I mean, almost certainly will get called away. And that's like, what, $3 below my cost basis? But I don't care. There's 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 two ways to make money in the stock market as far as I can tell. One is to be right a lot, and you can make tiny profits most of the time. The other way is, even if you're wrong a lot, if your wins are bigger than your losses, you will positively make money. You can pick one or the other. And for me, I make small profits over and over and over and over and over and over and over again. It just so happens that these two trades are losers, but it does not matter, because this 5K account that I started in March went down to 3. And then it went up to 8. And then it went down to 4.5. And now it's back up to 11. So there's some losers in here. But as long as it's consistently making money over time, granted, this isn't necessarily high frequency trading. It's not day trading, but it's a hell of a lot more high frequency than buy and hodl type traders. Or I guess maybe they're investors. They're not even trading. They're just buying and sitting on it. And that's completely fine, especially if that matches your style, your investment style. But over the periods of months, years, decades, if you're consistently making money, if you're consistently outperforming the S&P 500, that's kind of like the benchmark. Actually, it was the old benchmark. When you're a Bitcoin maxi, now the new benchmark is Bitcoin. If you're not beating Bitcoin, then just buy Bitcoin. Never financial advice, but I used to keep a little spreadsheet, and I'd put how much I bought it for and how much premium I got paid, and then I would knock down the cost basis 50 cents per share, and then I'd sell a covered call against it, and I'd knock it down another 27 cents per share. And just to kind of like prove that I was doing it right and keep track of my P&L and all that good stuff. And I think for anybody doing it at first should absolutely perform an exercise like that. It keeps you honest. Somebody recommended having like a trader diary or a journal. And that's kind of what an Excel spreadsheet is. That's what a profit tracker basically is. You're just kind of holding yourself accountable, and you can't ignore it. I mean, you kind of can't ignore it if your portfolio is going down in value either. But starting this in March and buying when Bitcoin was pumping, and buying mining stocks when Bitcoin was pumping, and then within a month, the Bitcoin tanks, that's fine. Like, that's the market that you can't control. Now, you could say, well, why were you buying these things when the market was at all-time highs or was up? Because when you start a strategy, you have to start wherever the market is. And I probably went a little too all in because I was trying to use all of my capital. I didn't want stuff just sitting in cash. A lot of people keep dry powder, but with this strategy, I'm constantly selling premium. So I'm constantly refilling my tank. I'm constantly accumulating dry powder. So I don't really necessarily feel obligated to just invest half and, oh, what if the price goes down? Now I got a dollar cost average. I don't really bother with that. I know people like to DCA into stuff and keep dry powder, but I'm comfortable enough with the way that I trade that that's not really necessary for me personally. Everybody should do whatever works for them. But it doesn't bother me at all that I bought CLSK for $15 a share, and now I'm going to have to sell them for 11 and 12, $11 a share, 100 shares for 11. There's no telling. If I had kept track, I would know exactly what my true cost basis is, but there's no telling without having done that what my actual cost basis is. My cost basis might be 11. I might have collected $3 per share worth of premium over the last 6 months. I don't really know. I know that my account is up, so it's not been more bad than good, I guess is my point. So I'm not afraid to lose money some of the time, as long as I'm not losing more money than I'm gaining most of the time, if that makes any sense. All right, I forget why I even got on that frickin' tangent, but I don't need to do anything with these two puts. They will likely be assigned unless CLSK pushes above 12.5 tomorrow. And if they do, then my frickin'... Oh, and actually, these CLSK calls aren't until 11:22 anyway, so these are not even expiring tomorrow. So anything could happen between now and then. So actually, this is a good exercise. The $11 strikes are the most that are in the money. These would cost me the most to roll. I am in no urgency whatsoever to roll these. This does not bother me in the frickin' slightest. The first thing that I do is come in here, and once an option becomes in the money, it begins to have intrinsic value. Intrinsic value is the profit that you could make if the call buyer exercised. So if a CLSK, the buyer of the call that I sold, if he exercised right now, I'd have to sell him my shares for 11, and he could turn around and put them on the open market for 11.96. That's the intrinsic value, that 96 cents. But these are worth, I'm sorry, 96 cents. But these are worth 227. And the value of an option is the intrinsic value plus the extrinsic value. The extrinsic value, meaning the value that I can collect if I just sit on my hands and do nothing for this option, is 223 minus 95 cents. So what is that, 28 cents? Or I'm sorry, $1.28. So there's still plenty, there's more extrinsic value that I can collect on this option than when I open the damn thing. So if I roll this now, if I start getting queasy and scared, and I'm like, oh, I gotta roll this, I don't want my shares to get called away. Well, there's freaking 4 weeks left on this thing almost. And the price could be $10 a share by then. So I can just sit on this for 4 weeks and let that extrinsic value, that $1.25, drain from this option from the buyer to the seller. And if CLSK is 11.93 on expiration date on November 22nd, yeah, then the value won't be this anymore. The value will be 93. Oops, I didn't mean to click it. And so if I wait until November 22nd and the price is still 11.92, then all I got to pay is 93 cents. I don't have to pay this 218. And what happens if I do roll this now and I roll it up like 60 days from now and roll it out to get a credit, and then the frickin' price does drop down to 10. So now I paid $200 to roll up, and I'm not going to make $200 on the way down. It's not going to make up for that. So when my strikes are threatened, when they are breached, as long as there's any extrinsic value left, I don't do a damn thing. I'll wait until a day or two before expiration. Just that's when the most likely time these will get exercised. Now, these are American options, so they can exercise anytime they want. I think it's European options. You actually can't exercise early. They're only exercised at expiration. So early exercise is not even something to worry about, I think, for some of the foreign markets. Don't hold me to that, but that's what I heard. Yeah, so there's nothing to do here for me. There's still plenty of theta for me to collect. Okay. These will either be assigned if possible, or if necessary. Nothing to do here. These are 1122s, 1122s, 1122s. I already peeled off one of these for profit. I've got my lone speculative MicroStrategy call, which is doing big things. I'm almost double up on this. I'm tempted to sell it. Maybe if this continues to pump before earnings, maybe I sell this right before earnings. Actually, this one's far out enough that it shouldn't be affected by earnings crush anyway. So forget I said that. I could just take profits on this thing, but I'm not really too motivated until at least January. And January is that epic expiration date that punter Jeff mentioned, where there's tons and tons and tons of long calls that people bought 2 freaking years ago when MicroStrategy was like trash. The price was just in the toilet. And so there's an enormous chance that a bunch of these January 2025 long call holders will be exercising at like something crazy. I don't know, $50 a share or something. I forget what the number was. This particular option, I normally manage these when they're about 90 days ahead. So this is like perfect. So in January of 2025, when potentially there could be some pressure on the market makers to go out and buy shares, this option could benefit from that. And even if the price isn't $450 a share by then, which it absolutely could be, just not counting on it. Even if the price has only, whatever, doubled by then, or gotten to $450 a share or $400 a share, like it's not quite in the money. It's not something that I could exercise. I mean, the value on this will be insane. It'll be almost in the money, and with 3 months left, so the value on this would be amazing. So I can just sit on my hands with this one and do nothing. All right, I got 6 minutes left before the market closes. Nothing to do here. I can hold on to that one. So here's the sad violins playing. I forgot when I was doing my little earnings research yesterday, my little earnings crush, I forgot to go in and take these off. So I just fucked myself out of $2,500 on this covered call option. And I limited my upside by $2,000 on this one. Now, again, this one's got 30 days to expiration, so I can run my little calculation again. 240 strike, price is 259, so that's 1,900 worth of intrinsic value. There's 28 minus 19 is $900 worth of extrinsic value. So I'm in no hurry to manage this one. This one I got to deal with because there's only 2 days to expiration. I could deal with it now, but that's not really necessary. I may just let them get called away anyway. I may do it early. Tasty Trade has this weird thing where when you're in danger of getting exercised on, they give you the option to like highlight them both and then close the position. I don't know. There's some kind of process to it. I had to figure it out last time I was upside down on one of these. But I do want to, I got a bunch more buying power here, so I'm actually kind of okay with this. I'm still using 6 figures in margin, so I don't like that. But here's the problem with Tesla. The margin requirements are so good that even if I close this, it's only going to increase my buying power by 6 grand. You know what? I'm just going to do it anyway, because this phase of my trading cycle, I'm all about MicroStrategy. All right, that puts a little bit of buying power back in my pocket. And let's check. Yeah, so that actually dropped. Yeah, I think that dropped my margin usage. So even though it only counted, that's interesting. So even though it only pumped up my buying power by whatever it was, 6 grand, I think I got full credit for margin. That makes sense. Because if they're only taking away, okay, maybe people are laughing at me for not understanding how frickin' margin works, but that actually makes perfect sense. So I'm thinking, okay, yeah, this, buying 100 shares of Tesla only counts, against me 9 grand. But that just means that the other 17,000 they're letting me buy using margin. So yeah, I was like, oh yeah, man, this Tesla's dirt cheap. I'm gonna grab 100 shares, and really all I did was just add a bunch of fucking margin usage here. And I'm as long as I can possibly get in MicroStrategy right now. So really, Tesla is there just to hopefully trick the Tasty Trade algorithm that I am not irresponsibly long MicroStrategy. Like, hey, look, I have other positions, I swear. Let me refresh this. Yeah, so 100 shares works for me. This one's still in the money. It's got 20 something days left on it. No reason for me to be hasty. This long call is about 17 delta of unlimited upside. I could almost double up on this, but there's no. This is speculative. I'm holding this for at least probably a year. IRA, nothing to really do. Ooh, this one's brutal. But again, 15 days left on this. Nothing to do there. And the joint account. Yeah, I'm just gonna manage this one. This is that 45 days to expiration put that I sold, and I'm gonna have to walk and talk at the same time here. I can close it for less than half of what I paid after 2 weeks. I just got that in under the bell. That was fucking awesome. Okay. That gives me a little bit of free cash as well in case MicroStrategy shits the bed at earnings. I have no reason to suspect that they would, but this level of margin is not the safest environment. So having some cash in this account that I could use to transfer over to cover a margin call makes sense to me, especially ahead of any binary event. Earnings is probably the most important binary event. Battery day for Tesla, investor days, shit like that. Those are generally not much of anything. I guess the election could be considered an important binary event. All of the Fed announcements and rate increases and decreases can be important binary events. Oh shit, the market closed, but I think these should still be accurate enough on Tesla. Let's see here. Little spreadsheet. So yesterday, the price was about 212. I'm just going to say 210 because the math is easier. And I went down $35 to this strike. And then I went up $40 to this strike. And implied volatility was 160, 130, 121. So let me check options. I'm going to go under the current price by $35, which gets me to 225, right? So, an in the money option. Christ. All right, so it's not telling me what the implied volatility is. It either can't calculate it because the delta is so freaking high. All right, let's go up a little bit. Okay, so we can get it here. So implied volatility is 129. And yesterday on in the money, it was 160. So let's add those at 129. And then at the money. The money. We got 74. And before, no. Where did my 129 go? Didn't I? Oh, I wrote it there. What did I just say it was 74? And yesterday was 130. So it does seem like so far that earnings crush is real. So let me try to go 230, go 40 above the current price. So I'm gonna go all the way to 300. Applied volatility is 118. Okay, so that's about the same. So the out of the money didn't really change much, but the in the money, or excuse me, the at the money collapsed in half. But I don't know how much of that is just because we're only 1 day to expiration now as well. But the in the money dropped from 160 to 130. And still I had to go, it's not really apples to apples because the price changed. And I couldn't go 35 below the at the money price. I had to go to 25 or 30. Let me, I should have checked the cost too. Out of the money for 300 strike. What's the cost? This part doesn't even really matter, I don't think. But 7 cents. So the price of the option that's the same equidistant amount out of the money did collapse. That's still not fair either because there's a day of theta decay between yesterday and today. So I don't know that this means much of anything. But let me at least go out to, let's see, December 20th. I think these were November, December, January. Yeah, these should still be within 90 days. So let me do, I'm going to try to do the 35 below and 40 above for December 2024. All right, 35 below the share price is 225. Implied volatility is 52. So that didn't really change. And the price is 43.95. So it's actually pretty consistent as well. All right, let's check at the money. Applied vol is 51. That's 24.88. Interesting. So this seems to be far enough away that earnings crush didn't affect it. All right, so now let me go 40 bucks over. So let's go to 300. Applied vol's 52 and 895. So I was kind of thinking it would affect these, but it looks like, how did I say the price was? 895. Very interesting. So it looks like it only really, earnings crush only really kind of affected these earlier options. I thought it would affect all the ones under 90 days. And if that's the case, then there's no reason for me to wait to buy MicroStrategy long calls until the day after earnings. My theory was that, okay, if earnings crush affects all of the options in the next 90 days after earnings, then I'll wait until the day after my earnings to buy some MicroStrategy long calls for January. But it doesn't seem like I need to worry about that at all, which sucks. I wish I would have bought them this morning before it rallied. But even though MicroStrategy's at all-time highs, that seems like conventional wisdom would say, oh, you buy low, sell high. Well, when a stock is at its all-time high, you should be selling, right? Well, that's only true if I think that the price will go back down before expiration. And of course, it's going to do some of this up, down type shit. But who knows how long I will have to wait to get a dip. It could be, I could lose a bunch of money buying at all-time highs, or I could lose a lot of money waiting for a dip that never comes, or maybe maybe MicroStrategy hits 275 before we get a dip to 250, and in either case, the current price is a discount. I am inclined to just pick up some long calls tomorrow, I think. I'm going to go and grab January. Probably going to end up all the way up here. And let's see, they're 800 bucks a pop. Did I dip my toe and just get like 5? Or should I? Yeah. See, I don't want to do anything too crazy before earnings. But grabbing a lot would cost me 16 grand. We'll see. I can sleep on that. All right. So it looks like earnings crush did affect this next expiration date, but it didn't affect. And this is Tesla we're talking about, but it didn't affect this one out to like 2 months from now. Maybe it's just too far away for it to really give a shit about earnings. So really, maybe earnings crush only applies to the very next expiration, or maybe it applies the most to this one and then less and less and less and less and less. All right, not as definitive as I would have liked, but I think that at least points me in that direction. That earnings crush is something that I should be worried about on the very next expiration, but less worried about after that. All right. Oh, this is my first episode after doing the MSTR True North episode last night. That was a frickin' blast. And thanks to everybody who came out and watched it. Can't wait to do more. And yeah, please continue to watch. Throw suggestions out there. We'll take a look, and if there's interesting comments or questions, we will get after it. All right, be good, y'all.